Well, good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house, coming to you from Palm Springs in the greater Coachella Valley area. And can you believe it? Our temperature right now is under 100 degrees. That's unheard of in August. We've got lots and lots of cloud cover, potential for rain. It's one of those sort of monsoonal thunderstorms, I think, coming through the area. So we will enjoy that while we can. We'll be back up above 100 in the mid, 100s to 110 for the rest of next week, I think. Jeff likes me to comment on sports report. I'm going to avoid that, at least as it relates to my baseball team. They lost yesterday 20-3. So forget about playoffs for the Angels. I'll have to either become a Dodgers fan or actually, I'd like to see the Padres maybe give the Dodgers a run for their money. It'd be nice to see the Padres back into the playoff picture. So we'll see how that plays out. Should be very exciting. And of course, being the home of what we call the fifth major here in the desert, La Quinta, the BNP Paribas Open. We're currently seeing the U.S. Open going on right now, so that's always fun to watch. So with that, let's go ahead and get right into what's going on with the markets. I'm going to have you give you some pretty good news. Our rate grid, first of all, when you look at it today, we've got some improvement. Mortgage rates, at least that we're offering, are extremely good right now. Forget about this. We're still close to 7 or even high 6s. We can now do a conforming 30-year fix with a good credit score and down payment size, 6 and 1/8. Same with the temporary buy downs, the 2-1 and 3-2-1. You can start at 3 and 1/8 or 4 and 1/8. FHA still there, right there, and VA in the mid fives. And actually, what's really interesting news, of course, the 15 years at 5 1/4 for a conforming loan amount. What's really good news is the jumbos are getting pretty strong in rate. So take a look at that if you want to get an indication of where mortgage rates are. We try to keep this updated daily. And for those of you who have not looked at it before, at the bottom of this page, you can see that link in red about mortgage rates. And I've got a short video there that gives you an explanation of how mortgage rates are determined from day to day. So it's kind of informational, but I think you'll find that information helpful to understand why rates are where they're at. So with that, let's go ahead and take a look at our bond yield. There's the kind of chart we like to see. Last Friday, it's a 5-day chart going back to last Friday. You can see the 10-year bond yield was getting close to 435, and big drop at the beginning of the week. And it kind of blipped up a little bit on Tuesday, but then a nice sloping downward up to and through today, down to about 4.21. So that's good news. That's what we want to see. I think in large fashion, some of this sloping downward in bond yield is probably evidence of the anticipation that the Fed is all but everyone agrees that the Fed's likely to lower the Fed funds rate in September. I don't think it's going to be more than 1/4%, but still, that's good news. Again, it doesn't mean when that occurs that mortgage rates are going to drop by 1/4% immediately. That's not how it works, but it certainly is an indicator and will help with the trend. It will eventually trickle through to mortgages, so we do want to see that rather than not see it. So in terms of what's going on in terms of the economy, the financial markets, data points this week, not a whole lot, but there are some that I want to share with you. New home sales, they beat forecasts. We've mentioned before on the show that home builders have been rather depressed, if you will. Market's been soft for new homes, and the home builder sentiment's been rather negative. But they beat forecast by a pretty good amount, 652,000 new home sales. This would be for July. And the reason? Incentives. Incentives sell homes. So I say that particularly for those of you realtors, if you're watching or listening and you're in the resale markets, don't forget builders are your competition. And they are doing whatever they can incentive-wise to sell homes. And this particular data point reflects that works. They have had an increase in new home sales better than forecast. So keep that in mind. That's a signal that for those of you who are selling your home or agents representing sellers of homes, understand that incentives can be a big part of your marketing plan and help you get that home sold if you've got a situation where your days on market's getting a little lengthy. Durable good orders came out this week. They were lower, I should say, but less so than forecast. So in other words, I guess I could say less bad than what the predictors were expecting. So that's generally good news. They were down a little bit, but not as bad as expected. Home prices. Case-Shiller index came out. Now this is an index that the latest release is for June, and the June release. And again, this index, the one I'm referring to, is an index based on 20 U.S. cities. So it's sort of a broad indication of home values. Obviously, local markets can vary from what this index is indicating, but overall, in June, home prices still went up. We keep saying it, although, yes, slowest increase in 2 years, but still up 2.1% year over year. Now, I saw some headlines that tried to take this and look at it from a negative standpoint that, home prices have gone up, but at a rate less than the inflation rate. Therefore, you've net that out. You've got a decline in value. I'm thinking that's a little bit excessive pessimism. Home prices are still going up, yes, at a slower rate. And if we keep seeing some more improvement in mortgage rates, as shown on our previous 10-year bond chart and our rate grid on our website, I think that could help reverse this trend, and home prices could start to get more support, and maybe we'll see some improvements in this index in the next couple of months. We are starting to see a lot more activity with buyers. I think finally buyers are starting to look out in the markets and consider looking at buying a home. The other good news, I think, is good news is today was a revision in the second quarter GDP. If you remember when that was first released, the Atlanta Fed in particular had forecast second quarter GDP would be 3.8%. It came out at 3% for the second quarter. That was the initial release. And there's always a revision that occurs at some point after that. Well, the revision in GDP quarter two came out today, forecast to be 3.1 instead of the initial release of 3.0. It was better. Second quarter GDP actually revised to 3.3% growth. So that's good news. That tells you that despite all the naysayers, the labor market appears to be pretty good. The economy still appears to be pretty strong. And so the idea that we're heading toward a recession, I think that really is not on the table. And I don't have it on this particular page, but initial claims for unemployment came out today, right there in that same range of about 225,000. So there's not been any big jump, big spike in people applying for unemployment benefits. So again, a further sign that while maybe there is a little bit of softness in the labor markets, it's been nothing substantial. And then for the rest of the week, coming out tomorrow, the PCE, Personal Consumption Expenditures Index, that comes out tomorrow. The year-over-year forecast is expected to be a flat number of 2.6%. In other words, the same number as the month before. And this is going to come out for July. So if that proves to be the case, and again, this is the Fed's favorite inflation number, I would say that's further evidence that we are not seeing any run-up inflation of any significant magnitude. And again, we'll see how this number comes out tomorrow. I have a feeling it is going to come out as forecast, and therefore I think we're going to be in pretty good shape that inflation does continue to at least be moderated, and certainly not looking to go up in any significant fashion. So that's your interest rate and mortgage market, bond market update. I want to go into now a brief couple minutes to give you sort of a product spotlight in terms of a loan program that I think needs to get more attention in the marketplace, particularly for home buyers. And as you see there in our header on this page, Opportunity Alert. Low rates with our Govy Arms. Y51 Govy Arms. Now, what I mean by Govy Arms, FHA has a 5-1 ARM product. Now, what does that mean? This is a hybrid adjustable rate mortgage. The 5 and 1 mean the initial rate and payment are going to be fixed for 5 years. After that 5 years, the loan will adjust annually for an additional 25 years. So it's a 30-year loan. So why would a 5-1 Govy arm be of interest, and why you should consider this if you're a prospective home buyer? Uh, Let me give you a few reasons. And by the way, this I'm bringing this up because I've always said, even if you have a good credit score, if you're looking to buy a home and you're going to put less than 10% down, 3% down if you're a first-time home buyer, which conventional loan allows, or 5% down, something less than 10% down, I always urge a prospective home buyer and their agent to consider FHA. FHA is highly competitive to conventional financing with minimal down payments. Yes, the mortgage insurance is a little bit higher than conventional, but that's actually only true for higher credit scores. When you get into the lower credit score spectrum, under 700, under 680, down in the 640, 630, 620 range, the conventional mortgage insurance with less than 10% down can get awfully expensive. FHA loans, therefore, should always be a consideration, I believe, in almost any market if the loan amount you need is within the FHA limits, which do vary by county. And if your loan amount you need is within those limits and you're going to put a minimal amount of down payment, again, FHA requires a minimum 3.5% down. And by the way, you do not have to be a first-time home buyer. That's a myth. That's a misunderstanding. You should always look at FHA as an option. And so given that backdrop that I've talked about for a very long period of time, that's why I want you to know about this 5-1 Govy arm, the FHA arm, because this really has been kind of under the radar and is a terrific product that you should consider. Now, the first reason why is because you're going to be able to get lower monthly payments compared to a fixed rate mortgage. These ARM loans, these 5-1 ARM loans, are offering an interest rate in the very low fives. For example, I can originate for you today a 5-1 FHA ARM at a rate of 5.125%. When you consider conventional loans as at least 1% higher than that, you got to look at this as an alternative. 5.125% is what you can see in terms of a rate available today for a 5-1 ARM. And again, that rate and the corresponding payment that comes with that would be fixed for the first 5 years of the loan. And of course, because of that very low rate, you're going to see a much better payment than if you look at a conventional fixed rate or even a FHA 30-year fixed rate. Remember, on our rate grid, an FHA 30-year fixed is about 5 5/8. This is a 0.5% lower than an FHA 30-year fix. So there you go. Whether you're looking conventional or an FHA 30-year loan with less than 10% down, this 5-1 ARM is very attractive and should at least be part of your consideration and a conversation we should have when you're contemplating which loan product to take. So the other thing about this that is very important to understand is qualifying. With a 5-1 ARM, you're going to qualify at the start rate. Again, most ARM loans, certainly conventional adjustable rate mortgages, if you're going to have a fixed term of less than 7 years, like a 5-year ARM, 5-1 ARM as we call it, or even a 3-1 ARM, you are not going to qualify. In other words, your debt ratio is not going to be calculated off of that initial 3 to 5 year fixed payment. It's going to be calculated at the index plus margin, and a lot of times they'll add 2% of that. They're setting an artificially higher qualifying rate to guard against potential future adjustments upward in the loan product. FHA 5-1 ARM doesn't work that way. That 5.125 rate I mentioned earlier that we can offer on a 5-1 ARM, your debt ratio will be calculated off of that rate. That gives you more purchasing power. You can qualify for a greater loan amount with this product by nature of the fact that it's got a much lower interest rate starting off than a conventional or FHA 30-year fixed. The next thing to understand about this product is the cap. The number of 1 in the 5-1 descriptor of this ARM loan means the annual adjustment cap is only 1%. Now, what that means is after 5 years, this loan is going to adjust the first time in the beginning of year 6. The adjustment is going to be based on the index that this loan is tied to, which I'll mention in a minute, with a margin added to that. and then that sets your rate for year 6. But if that formula, index plus margin, beginning of year 6, calls for an increase in your rate by more than 1%, you're capped. The increase will be capped at 1%. So that means if you got one of these at 5.125, you're now in year 6, you're about to have your first adjustment. And if the index plus margin calls for a rate to go to, say, 6.5, you're not going to pay 6.5. You're going to be capped at 1% above your start rate. That's 6 1/8. 5 1/8 plus 1, 6 1/8. This is the best annual cap on an adjustable rate mortgage on the market today, and that frankly has been for pretty much since this program was created. A conventional ARM loan, conventional adjustable rate mortgage that has annual adjustments, what you're going to see is the annual cap is going to be 2%, not 1%. So you're going to be exposed to a higher amount of potential increase than you will with this product. Not to mention the fact, a lot of a lot of conventional ARM loans, the initial first year adjustment, sometimes the cap is the same as the life cap, meaning in that first year after 5 years, you could potentially have an increase in your rate of up to 5%. With the FHA ARM, there is no such initial cap of 5%. You're at 1%. So that's why this is an incredibly good and safe product for borrowers, because you are insulated from substantial increases even when the loan starts to adjust after the 5-year fixed period. And then the last thing I want to mention about this is the margin and the index. Now the margin, let me kind of rephrase this. The index that this loan is tied to is the 1-year CMT. That's the 1-year constant maturity treasury index. That's what this loan is tied to. So what that means is after year 5, at the beginning of year 6, that index will be used to set your rate for year 6. And then what is going to happen is a margin is going to be added to that 1-year CMT. And in this case, it's 2.25%. That's a very good margin, a very low margin. And right now, the 1-year CMT is about 3.85. So if you take 3.85 plus 2.25, that's going to be about 6.15. That would be your potential rate in year 6, again, subject to that 1% cap. So this particular product has a very good index with a pretty low value. The 1-year CMT is pretty darn competitive as an index for ARM loans. And then when you're adding only a margin of only 2.25%, that means even if you're going to have an increase within that 1% cap, you're going to be better off with this kind of adjustable rate mortgage than virtually any other conventional adjustable rate mortgage. That's another reason why this is a tremendously good product. It needs to be better known. I want to get this out to all of you. So if you're either a prospective buyer and you're contemplating FHA as an option, we want to make sure this becomes part of the conversation. I'll be happy to give you some numbers to compare this to a regular FHA 30-year fix. And again, certainly too, if you're an agent, you're working with a buyer, and you've already determined FHA financing is what you're going to use, or maybe what you need to use for qualifying purposes, this has to be in the conversation too, because this, as I pointed out earlier, could provide you even more purchasing power than FHA loans tend to provide you anyway compared to conventional financing. So get the word out. Anybody considering FHA financing for the purchase of a home, give me a call. Let's have a conversation. I would be happy to give you some numbers to go over so I can show you the benefits of this product compared to a 30-year fix. And of course, what we would do there is talk about the scenario of the 5-year fixed term, what happens after that 5 years when the loan starts adjusting, what kind of things should you consider when you're contemplating using this product, how safe it is, and so forth. So we can have that discussion. I can show you some numbers. And I think once I do, you're going to find this should be a very good option for you to consider in buying your home, particularly if it's your first home. Okay, with that, we're going to go ahead and get into a little bit of discussion about something that's been kind of timely in the news lately, and that's mortgage fraud. So with that, now we've got here a slide that's maybe a little bit aggressive in the sense that don't make a mistake of getting a home loan and then end up getting handcuffs if you do something that was quote unquote against the law. So maybe this is a little bit dramatic, but I want to talk about this a little bit because it has been in the news. And there are some real issues related to mortgage fraud, but I also at the same time want to kind of give you a better idea of what to be concerned about and what's maybe not too much of a concern, but you should at least be aware of. So let me first start with uh, the federal government uh, studies mortgage fraud, and they've actually come up with a list of the most common types of mortgage fraud that they see in mortgage originations. Now, fraud is a strong term, but the real point of this here is that when you're applying for a mortgage, you are making representations in your application. And some of those representations are subject to being validated and verified. And if you misrepresent something in your application, you could be exposing yourself to possible prosecution, believe it or not, because misrepresentation or essentially lying on a mortgage application can be a federal crime, and it would be investigated by the feds, as you would say, the FBI, for example. I think I mentioned in a show here months and months ago, when I was first in the mortgage business, I actually ended up in a situation where I had to testify before someone being prosecuted for FHA loan fraud. They were actually going after the borrower because he was considered involved in organized crime out of Chicago. And as they tend to do with those kind of folks, they were looking for any way they could to get this guy. And so they were using FHA mortgage fraud as a way to get him. So this can be a real issue at times. So let me talk about the most common one, and again, the one that's been in the news lately, and that is occupancy fraud. So what is that all about? Well, when you apply for a mortgage to buy a home, you are going to indicate in your application what the disposition of the home is going to be. Are you going to use it as a primary residence? Or are you going to use it as what we call a second or vacation home? Or are you going to use it as a rental property? Now, what we see from time to time is that folks will apply for a mortgage to buy a home, and they may already own a home. And in doing that, they may decide that they want to apply for that home and claim that it's going to be purchased as a primary residence. Now, that's fine. But then, of course, it creates the question of what are you going to do with your existing home? Well, in these kind of circumstances, sometimes they're going to say, well, I'm going to keep my home, my existing home. I'm going to sell it later, or maybe I'm going to rent it out. And so they'll go ahead and say, I'm applying for this purchase loan because I'm going to live in this house I'm buying as my primary residence. But then when you dive deeper, sometimes what we realize or we detect is that maybe that's not the real intent. That the real intent of applying for the loan and saying it's going to be a purchase of a home as a primary residence is that they're saying that because they want to get a better rate on the loan. In other words, more favorable loan terms. And the reason for that is because if you're going to buy a home and you're going to finance it as a second home or a rental property, your rate is going to be higher than a home you live in. And that rate range can be a good amount, 0.5%, maybe 0.75% higher, maybe even a little bit more if you're on the lower credit score spectrum. So you will sometimes see folks applying for a mortgage and say they're going to live in the property they're buying, when in fact, the reason they're saying that is simply because they want to get a better rate. They want to get around the higher rate that would be available if their real intent is to use the home as a vacation home, which these days many vacation homes are used as a combination of for the owner's personal use, but then a lot of times they're using it as a short-term rental, or they're outright really buying the home to be a rental property. That kind of representation definitely is considered fraud. And I say it's been in the news lately, as you may know, because a particular Fed governor, some member of the Federal Reserve Board, is being accused of doing exactly this kind of thing. Apparently something to do with applying for a mortgage for a home, I think in one state, I want to say it was Michigan, and then in another state in Georgia. and doing so in a relatively brief gap between the two transactions, but in both situations allegedly applied for the loans as their primary residence. Well, you can't live in two homes as your primary residence at the same time. So that is a real issue. And believe it or not, this type of fraud, where you're misrepresenting your intended use of the property, saying you're going to live in it when maybe you're not really intending to do that. This actually is the number one type of fraud we're seeing in the industry today. I do run across it from time to time when I get somebody inquiring about being pre-qualified to buy a home, and they end up telling me, well, I'm going to live in it. Well, when I ask them questions, find out that they own a home currently, one of the clues, one of the red flags that we rely on is we'll look at um, the home they own now. What's the size? What's the room count? What's the bedroom count? What's the bathroom count? What's the value? If you're buying a home that's, $450,000 and it's a condo, and you're saying you're going to live in it, but you own a single family detached home and its value is $1 million, and it's a 4-bedroom, 2-bath with 3,000 square feet on a quarter-acre lot, well, that's a red flag, because it calls into question, why would you move out of this much bigger, nicer home at a much higher value, and then you're going to move into a condo that's half the value, and it's maybe 2-bedroom, 2-bath, and 990 square feet? That kind of challenges logic as to why would you do that. And of course, oftentimes we find out it's simply in pursuit of a better rate, because that applicant is aware, if they say, well, I'm really buying that condo as a second home that I'm also going to use for short-term rental, they are already maybe aware that rate's going to be higher than if they say it's a primary residence loan. So that's where you got to be careful. You don't want to do that. And once I realize with anybody who's inquiring with me, and wants to take that approach, I usually advise you don't want to do that. And pretty much, not just that, I'll say, I'm sorry, I can't arrange your loan for you unless you're willing to be honest about how you're really going to use that property. 0.5% rate just isn't worth it. I don't know why folks would even think that makes sense to do. Now, there's been some question about, in the particular news story that's been out there circulating about this particular subject, is this really a big deal? I mean, after all, in fact, I'll admit, in most cases, those who get away with this type of approach usually they don't get caught. They don't, get handcuffed, as our previous slide showed. They usually are okay. It goes undetected, in particular if they're making the payments on time. But what's a little bit ironic about this particular type of fraud is that the Federal Reserve Bank of Philadelphia did a study on this particular topic just 2 years ago and published that study, and found that in reality, this is the number one type of mortgage representation or fraud, and that the rate of default in this kind of scenario where people were able to get away with it is 75% higher than a primary residence loan where they really intend to occupy. So it's just kind of ironic that the Federal Reserve issued a study within the last 2 years to establish that this is a real issue, when somebody who's part of the Federal Reserve now is being accused of doing the same thing. So again, I'm not trying to be political here. It's just interesting that these two facts are kind of floating out there, and it kind of just underscores why this is a significant issue in all seriousness. Again, it doesn't mean that a lot of people are getting handcuffed and going to jail, but it is something that I would caution you, I would counsel you. It's just not worth it. If you're buying a home and it's going to be a second home rental property, just say it like it is. Look at the rates that are available. By the way, we're very aggressive on how we price our second home and rental property loans. So check with us, even if you're going to be willing to get that higher rate. We could probably get you a better higher rate than most of our competition. So you'll want to definitely look into that. The other couple of other types of mortgage fraud I want to touch on real quick. And I'm going to bring up this next one only because it's also been in the news, although not immediately currently, but within the last couple of years. And that is what is often called appraisal fraud. Okay. appraisal fraud or property flipping. Now, part of that, the property flipping part, is pretty much involves situations where there's actual fraudulent appraisals being done in order to get better terms, and in particular to basically get a transaction done where you're going to acquire the property, use a fraudulent appraisal to get a higher value, higher loan amount, and then you end up flipping the property. So that does happen. That's something that the industry is very kind of focused on, and there's lots of ways that can be detected and prevented before it actually happens. But the other part of appraisal, I'll put fraud in quotations, is of course the recent last few years regarding our current president, and the idea that in the state of New York he was prosecuted for essentially fraud as it relates to applications for big loans, commercial loans, where he made a certain representation about a property in Florida. I think you've all heard the name of that property. And he was prosecuted for that. Now, again, I'm not trying to be political here. I'm not trying to defend our current president. But except for the technicality, I want to kind of educate you on what the issue was. The state of New York decided that he was grossly inflating the value of property, including his residence in Florida, and I believe on some of his commercial properties. Well, I want to tell you that in itself, that's not fraud. It is common, actually. When we do refinance loans for people, whether it's a rate and term refinance on their home, whether it's a primary residence or a rental property or a second home, in that application, the borrower is going to be asked in the application to provide what they estimate their value to be. And they do that. And I got to tell you, in some number of cases, that number that borrower, that homeowner puts in their application can seem rather lofty. Their estimate of what they think their home value is worth can sometimes be way off from reality. But that in itself is not a misrepresentation. It's an estimate. It's an opinion of what that owner of the property thinks it's worth. So that's why in the court cases with New York and our current president, hearing all about that and reading some on it, I was scratching my head, because there really wasn't a crime there, technically, because there were certain estimates provided. But in the industry, that's understood. And so it's up to the lender to then do their due diligence to determine if that estimated value that the borrower put in their application is valid. Is it accurate? And is it anywhere near accurate? Is it higher? Is it lower? So what the lender will do with that application, it's a very straightforward process. Most of you already know about this. They're going to get an appraisal. That appraisal is going to be a disinterested third party, usually state licensed, who is then going to get that appraisal order. They're going to go out and inspect the property, interior, exterior, usually measure the whole property, et cetera, look at all the amenities, the size, the room count in residential situations, and they're going to come up with an estimated value, an opinion of value, after looking at the property closely in and out, looking at comps in the area, and then coming to this opinion of value. That opinion of value becomes the controlling document to establish what's going to be possible for the borrower in terms of the loan that they want to get. So at that point, whatever that estimated value was that the borrower put in their application is pretty much dismissed. It's set aside. It's no longer relevant, because the lender did their due diligence to get a third party opinion of value from a licensed professional, and that's what is going to be taken and used in the loan decision. And by the way, that appraisal report from that third party professional licensed appraiser is still going to be subject to underwriting review. So again, further review to establish that that opinion of value is valid. So that's why it was odd in that very famous case with the state of New York and our current president that he was prosecuted for that, because in that case, from what I understand, the lenders took all those steps, did the appraisals, underwrote the appraisals, They did make loans based on those appraisals, not based on some estimated number in the loan application. And from what I understand, all those loans were paid back timely. So that's why they call that a victimless crime. So again, I'm not trying to get political or defend our president in any other way other than this narrow technicality of, was there really any kind of fraud going on there with regard to inflating values of his particular properties? I would argue no. The system is set up for independent evaluation of those, could be inflated value estimates that the borrower, the applicant provides, but otherwise there's no crime there. And so that's what the industry does to protect their lending interest, to make sure they're making a loan on a property that is independently valued and in order to meet loan to value requirements. What I understand from that whole couple of years of legal proceedings was the court in that case actually estimated that the value of that property in Florida was $18 million. Well, I think most of us have heard about, seen pictures of that property. It's oceanfront. It's extremely large. Several acres of land. Frankly, again, I'm not trying to take sides here, but $18 million is a laughable estimated value by the judge. And obviously, when it comes to the whatever loans were obtained, a much higher value, I'm sure, was determined by the lender, but somehow that got missed in the story. So just understand that when you're applying for a loan, you can estimate whatever you want you think your house is worth. You're not going to get in trouble for that. You're not going to get into handcuffs, at least with regard to most any other state, because there's just no crime there. So I just want you to make sure that you understand that and understand that distinction. So the next thing I want to talk about, two other things, is wire transfers. This is a big deal, and you've got to be extremely careful when it comes to wire transfers, which can involve phishing, and as well as cyber crimes. And I can tell you a story personally that I indirectly got involved in. I had a purchase transaction I arranged back about 8 years ago here in Palm Springs, and the borrower was preparing to close. We'd already gotten their loan approved, was putting a substantial down payment, and we got down to closing, and the borrower was required to send in the rest of their money that they needed to close the deal. The amount of money they had to send was $350,000. So he had obtained the wire instructions, got those instructions, ordered the wire got sent. Problem was the title company, after a period of time, said, "Excuse me, where's your wire?" And of course, the response from the borrower was, "Well, I sent it. Here's the evidence." Well, it turns out that wire got intercepted by cyber bad guys. It never arrived at the title company. Now, it turns out in this case, somehow the wiring instructions got to the borrower through an email that was not encrypted, and somehow en route from the title company to the borrower, the wiring instructions were altered to result in the fact that when that money was sent, it got sent to, I think, an overseas bank, and the borrower couldn't close. Now, in that particular case, believe it or not, the borrower, being informed of this, then got wiring instructions again, but this time called the title company, got it over the phone, resent the wire, and this time it went through. And then, of course, after the deal closed, he pursued litigation, actually with the title company, accusing them of sending the initial wire instructions unprotected to him, which I guess there was some debate about whether that was true or not. But the important thing to know, wire transfers are a very, very big deal in the mortgage industry. It's an area where fraud is pretty darn common. So if you're in a real estate transaction that's going to involve you sending any significant amount of money to the settlement agent, to the title company, the escrow company, you've got to be extremely careful when you get those wire instructions, how you get them. Make sure you got them in a protected fashion so that you're not going to be subject to this kind of fraud. because otherwise it could cost you dearly in terms of lost funds when you're trying to close a transaction. So I can't stress that enough. When you're getting involved in a transaction where you've got to send money to the settlement agent, you've got to take all the steps you possibly can to make sure that money is going to arrive, and you're not going to end up seeing it stolen by some cyber criminals, because they're out there standing by waiting to take advantage if somebody slips up and doesn't follow the procedures correctly. And then the last thing I'll point out, I see this occasionally, straw buyers. From time to time, we'll encounter a situation where somebody's applying for the loan, and then we come to realize there's some red flags, some signals kind of that we're detecting that maybe this particular borrower isn't really looking to buy the home for themselves, but for someone else. In a lot of cases, that's a family member, and it's usually pursued in an effort to get better terms for that person who's actually going to occupy the property rather than the person who's applying for the property. You've got to be careful about that, because again, it kind of spills over into the occupancy fraud issue, right? Because if you've got somebody who's saying, I'm buying this home, I'm going to live in it, but then we figure out that they're going to not live in it, and then they're actually buying it for a family member who's going to basically take possession of the property, and they both go on from there. That's a problem, and that is going to get you in trouble in terms of misrepresentation and getting into a situation of committing, yes, the word is a strong word, fraud. So again, we try to keep our antenna up about those kind of situations. If I run into it, I'm usually going to point out to the folks, you know what, you really don't want to do this. And by the way, you're making assumptions about the loan terms that the real person who's going to occupy the property can get without knowing for sure. And in some cases, and I haven't run into this very often in my over 4 decades, but there's been a few instances. Once I dive into it a little more, what I find out is that in reality, they should have at least checked out more thoroughly what kind of terms the person who was really going to occupy would get based on maybe their lower credit score, and then realize that it's not so bad. So there's no reason to bring in some other person to be the straw buyer just to get a little bit better, 0.25%, 3/8, 0.5% better rate, because they're afraid that the person who's really going to occupy can't get a good deal. I mean, that's kind of the real fundamental problem, is they just make assumptions, uninformed assumptions about, what kind of terms the real person who's going to occupy can get. And so once I point that out to them, I've been able to basically keep this kind of situation of using a straw buyer from happening. And then one last point, and again, it spills over into the occupancy issue. There's sort of a reverse thing that's going on in some cases. We'll have folks who are applying for a home, they're going to live in it, but we determine that they're not going to qualify for a conforming loan based on their documentation. Their debt ratio is too high, and so forth. They're just not able to be qualified for a primary residence full documentation loan. A common strategy lately is, okay, we'll use a low doc program, like a debt service coverage ratio program. Remember, that's one where you don't disclose your employment. You don't disclose your employment income. All that's blank on your application. And instead, you get qualified based on the relationship of the housing expense for the property, or I'm sorry, for the loan amount you're requesting versus the market rent for that property. And if they equal each other, break even, or it's positive cash flow, you pretty much get the loan. The problem with that is a loan designed specifically for rental properties, for real estate investors. And so if you're trying to buy a home as a primary residence, you're deemed to not be able to be qualified based on documenting your income. It is not advisable to then say, I'm going to buy this as a rental property just to get the loan and avoid the income documentation and debt ratio challenge, and then get the loan because the property cash flows, where you're representing you're going to rent it out as a rental property, you're not going to live in it. That can get you in trouble too. So I want to tell you, don't even go there. I've encountered that a couple of times here recently, and I've basically talked the people out of it. It's not worth it. That would be prosecuted. That would be something that would definitely get you in trouble. That's not something you want to do at all. So with that, I just wanted to make sure you understood some of the issues that we see in the mortgage industry, as if, as it relates to mortgage fraud. Now, Jeff just pulled up something here. What if I buy a duplex and live in one side? That's fully okay. There owner-occupied loans on 2-unit, 3-unit, 4-unit properties are absolutely positively okay. You can represent that you're going to live in one of the units and then rent out the others. Now, you do have to do what you say and live in one of the units, but if you do that and then you're renting out the other two or the other 1, 2, or 3 units, perfectly acceptable. There's no fraud there at all. You're on safe ground. And so, in fact, I've been talking about, for those of you who are first-time home buyers, you should consider that option. Consider a 2 to 4 unit property. Live in one of the units, use rental income from the other, 1, 2, or 3 units to get that income to help offset the mortgage debt. That's a great strategy to get into housing as a first-time home buyer. And then eventually you can convert that fully to a rental property, an investment property, and then move on to buy, a primary residence home. And then as to the other thing you see on the screen, am I expected to live in one unit for a certain period of time? It's kind of a gray area, but I would certainly suggest you probably would want to live in it, that one unit for at least a year. After that, sure, if you're in a situation where you're ready to buy another property that might be a single family resident that would become, again, your primary, then you can rent out that remaining unit that you just vacated. You should be good to go there. Okay, well, I hope this information has been helpful to you today regarding both. Don't forget that 5/1 FHA ARM. That's a great product. Love to talk to you more about that if you're looking to buy a home, as well as what things to watch out for as it relates to mortgage fraud. So I appreciate you watching and listening to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Have a good weekend, and we'll see you next week. So long. Take care.